A debt consolidation loan can be a good idea to get a handle on your debt. But how does it work and when do you know if it's the right solution? Let's walk through what a debt consolidation loan is, how it works, and when to know it's the right move for you. So, what is a debt consolidation loan? A debt consolidation loan is a loan that helps combine your existing debts into a single loan with one monthly payment. It consolidates debt from personal loans, credit cards, and even medical bills. And debt consolidation loans typically have a lower interest rate than your current APRs, so you can save money on interest and pay off your debt faster. A debt consolidation loan can also help simplify your finances with one single monthly payment that goes towards the debt consolidation loan. Qualifying for a debt consolidation loan does depend on your credit score. The better your score, the more options you'll have, and the less interest you're likely to pay. So how does a debt consolidation loan work? A debt consolidation loan will be paid out to you as a lump sum, which you can use to pay off the creditors and the existing debt you have. Loan amounts range from about $1,000 to $50,000, and you'll have from either 2 to 7 years to repay the loan. Let's look at an example. Let's say you have 4 credit cards, each with a $5,000 balance. Instead of making monthly payments on each credit card, you take out a debt consolidation loan for $20,000 and use that money to pay off your credit cards. You're then left with one monthly payment on your new loan. When debt consolidation can be a smart move? It can be a smart move if you get one with a lower APR than the rate on your existing debts, and you can comfortably make the monthly payments within your budget. A debt consolidation loan can be a smart move if you have a goal to pay off your debt. For instance, if you take a loan with a 3-year term, you know it'll be paid off in 3 years, assuming you make your payments on time and manage your spending. It is recommended to consider a debt consolidation loan when you know you can pay it off within 5 years. When debt consolidation isn't worth it. Debt consolidation doesn't address spending habits that create debt in the first place. It's recommended to avoid building a balance back up on credit cards you have paid off. It's also not a solution if you're overwhelmed by debt and have no hope of paying it off, even with reduced payments. If the total of your debt is more than half your income, you might be better off seeking debt relief than treading water. Or if your debt load is small, say you can pay it off within 6 months to a year at your current pace, you'd save only a negligible amount by consolidating, so don't bother. Instead, try a do-it-yourself debt payoff method, such as the debt snowball or debt avalanche. How to get a debt consolidation loan. The first step is to check your credit score. Your credit score and credit history play a large role when qualifying you for a loan. Borrowers with good to excellent credit, which is a score of 690 or higher, and with high incomes, tend to qualify for more options across lenders, and often the lowest interest rates. Borrowers with fair to bad credit, which is a score of 689 or lower, might look at lenders that specialize in bad credit borrowing specifically for debt consolidation. Next, pre-qualify. Pre-qualifying will help give you an insight into some rates and terms that you can expect. It's also a great way to shop around and compare different lenders. Pre-qualifying also just requires a soft credit check, so it won't hurt your credit score. You can pre-qualify with lenders at NerdWallet.com. Next, make a list of your debt and make sure that your new debt consolidation loan covers the combined amount of your existing debt and that your interest rate is lower than the interest rate you have on your current debt. Next, make sure that you can make the monthly payments on a new loan. A debt consolidation loan is not helpful if it puts you more in debt. So once you have your credit score, an interest rate, a loan amount, take a look at the different lenders, compare options, and find the one that's best for you. And lastly, submit a formal application. This will require some personal details as well as a hard credit check. Typically, lenders approve within 7 to 10 days. If you decide a debt consolidation loan isn't for you, there are other options. You could look into refinancing with a 0% balance transfer credit card. You can ask family and friends for a loan. You can tap into your home's equity or take a loan against your 401k. To see if a debt consolidation loan makes sense, take a look at NerdWallet's Debt Consolidation Calculator. You can plug in your existing debt and credit score to see your consolidation options. You can also calculate your potential savings with the debt consolidation loan. At the end of the day, consolidating debt doesn't address overspending habits, so establishing a realistic budget and sticking to it is still important. But a successful debt consolidation can make managing your debt easier, as well as even improve your credit score as long as you make on-time payments and you keep your balances low on your credit card. Debt consolidation can be a light at the end of the tunnel for many borrowers. You can save money on interest, and your debt can be paid off within a certain amount of time. It makes finances and debt management easier. Hi, I'm Ronita, a personal loans expert here at NerdWallet. I hope you liked this video, and if you did, please like and subscribe below.